For more on what all this means to the markets, let's bring in Barry Knapp. He is managing partner at Ironsides Macroeconomics. Barry, it's good to have you. Now it sounds like, based on the conversation we just had a few moments ago, that the odds for some kind of relief package are a little bit higher now. And where do you think that leaves the market?
Yeah, I was a little taken aback by the initial market reaction this morning, because my response to that diagnosis of the president was that this would actually embolden the purveyors of lockdown nation, those that have really advocated non-pharmaceutical interventions. And so I thought, well, that meant tech ought to really rally. That was okay with me. I upgraded it a week ago after having downgraded it in August. But the rally seems to be all about a fiscal stimulus package. Now, I guess I understand the logic of this, which is the idea that you create a whole lot of fiscal stimulus, it's monetized by monetary policy, and that lifts asset prices. I think, though, the market's going to look through that fairly quickly. Now, by fairly quickly, I don't mean necessarily between now and the end of the year. The market might grasp onto all that and say, okay, we're just going to throw a lot of liquidity at the problem and the markets are going to rally. But I think when we move into 2021, we're going to realize that, transfers to state and local governments will slow the reopening process. More $600 supplemental unemployment insurance will slow the recovery in the labor market. Today's payroll report had NPIs or lockdown nation written all over it. You could see sectors like, retail and construction doing much better than leisure and hospitality and education and health. The 230,000 state and local education teacher jobs that were lost or don't probably. All of those things sort of speak to how quickly we reopen and safely we reopen. So, that to me is the bigger, longer term issue for investors who are more concerned with the performance of the next year rather than the next couple of months.
And so Barry, it's interesting because you're saying basically as goes kind of the lockdowns, so goes the economy and so goes the markets. And you think that Trump's diagnosis makes more lockdowns more likely. Is that even if he kind of shakes it off?
No, that's a point that I was going to add on for sure, is how well he does will determine the path of the lockdowns and may, be an opportunity for him to turn around, the possibility or probability of being reelected as well. I mean, if he shakes it off, if he responds to it like Bolsonaro or even Boris Johnson, who seemed to get through it, be able to work through most of it, although I think Johnson was probably a little sicker than Bolsonaro. But if he's able to work through this process, then he gets to do a little bit of a I told you so. And that may actually help his election prospects and certainly will help the reopening process.
Yeah. And Barry, real quickly, then, where would you put investors, in the reopening trade or in the rotation? That's one and the same. Into the reopening rotation or stick with lockdown nation?
No, I've liked the technology sector because of secular trends like, movement to the cloud, digitization. I would still be market weight in that. I wouldn't be underweight, but I'm not going to pull, the rug out from under the belong cyclicals, belong industrials, belong in materials, because I do think that we're going to continue with the reopening process. And to me, the economy is showing a lot of dynamism. The recovery in small business employment relative to large business employment from the ADP report this week was a great case in point. So I want to stick with that cyclical impulse, but we may have been dealt a setback depending on how the president responds to the virus in the next 2 weeks.
Yeah. It is amazing how much is going to come down to that. Barry, appreciate you connecting the dots for us today. Thank you, sir.
Shepard Smith here. Thanks for watching CNBC on YouTube.